Hey, good evening, guys. Ken at Tortoise Capital Small Group Coaching, Cohort 1, May 22nd, 2024. We're welcoming Sundeep Gupta, good friend, long-term collaborator to the team for Cohort 1. We're going to go over some of his foundational documents. We have a Q&A from Juan Carlos and then check-ins from the gang. I would say for my check-in today, so I spent 4 hours in essentially a master's program group debriefing from military scholars at our college. We interview like the dozen best and brightest guys that have an interest in information operations or information advantage, and they do a focused program of study outside of their normal curriculum. They get to travel and talk to movers and shakers and then work on what it means to engage in the full range of operations with information in the modern world with a lot of gray area stuff, because they're looking at the ways that diplomacy, information, military, and economic policy and actions it come together for strategic national defense. We had a chance to hear some presentations from guest speakers that our foundation flew in, including a guy who's been a 30-year storyteller engaged in story science. I'm going to link him up with Angus Fletcher. We're going to get some kind of partnership going between Ohio State and Stanford and this guy. He knows my doctoral mentors, and we had a pretty interesting exchange. And also an Air Force retired colonel who's running a Indo-Pacific area think tank that is trying to engage with the People's Republic of China on information warfare and engagement across the full spectrum of policy and propaganda. It was pretty neat. The introduction to him featured about 5 minutes of Chinese propaganda about him and what kind of a CIA stooge he is and how he's trying to, poison the well when the Chinese are just trying to get along with everybody and do the right thing. And it was kind of an interesting journey. That tactic fits exactly into the scholar Li Zhongwu's thick-faced black heart theory back from 1911, talking about how to engage in subtlety and subterfuge and deception and misdirection. So it was kind of interesting to see how all that shook out in terms of storytelling and creativity. And it tells me that we're on the right track with what we're doing with personal narrative, sense making, and trying to grapple with complexity through the power of our storytelling, story thinking brain. So had a lot of interesting discussions on that today. I got to prepare a paper. Artificial intelligence was prominent in every single person's presentation, and the topic of all the panels all came down to the use of AI to assist with reasoning and complex level policy and decision-making support, which I've been working on personally for a couple of years, and very exciting stuff. So that's my check-in, and looking forward to hearing from you guys. Let's go with the trader check-ins first, then we'll do Sundeep, and then we'll get to Juan Carlos's Q&A section. If you want to do that together with any summary of work so far, Juan Carlos, we can do that after we do Sundeep. So if George or Jonathan, if either one of you would like to get us started, off we can go.
I can go ahead. So overall, I think the trading's moving in a positive direction. I mentioned I feel like I'm starting to feel like I'm trading effectively. This week, I guess, notwithstanding, I think Monday and today are the first days I've actually had in a while where I had negative R. I got chopped up pretty well today. with EWW. But I think that we finally closed on the house last week, and things are starting to kind of settle down a little bit. So one of the things I really need is consistent desk time, and really try and be trading most days, which I'm now going to have a period where I'm able to do that. So I'm hoping that that will really augment my progress. And I think we talked a little bit about being able to look at, or adding a name to EWW. And I really haven't focused on that. I've kind of dabbled a little bit. I've got DIA up on one of my screens, and I'm looking at it. Today I paid a little bit more attention and really found that it was challenging trying to focus on 2-3 minute charts at once, which I think I'll be able to do with practice. But my thinking is that I'm still not automatic enough with the trading to be able to just kind of react when I see setups or exits or areas which need to be adjusted to do it on more than one chart. So I think that's, and especially on a day like today where during the time that I was trading, EWW really didn't have a lot of great moves, but DIA, I can't remember when it had a couple of good runs. I'm not sure if it was during the same time I was really looking at EWW, but having something else to go to where, the name that I'm trading, may just not be doing what I needed to do. It just may not be cooperating, and I need to be the name that's more favorable. So I think that that's something that I need to kind of work on over the next couple of weeks and see if I can develop that skill a little bit more.
What I'd like you to add to your presentations now in the next couple of weeks is you start tracking the week-to-week performance curves and stats the way George is doing it with his rolling, because as you're kind of settling into EWW and you have feelings and impressions about adding DIA, we want to see if those insights are anchored in and aligned with the data that it's that you're collecting. Another thing I would say is I would be watching DIA on 30 minutes, not the 3 minutes, because
Okay.
then you don't want to be starting the day with those two competing against each other to see which one you
Right.
want to do. What you want to do is have that kind of in the background as the satellite image of the long-term traffic trends of the market. So much slower moving to give you a general sense of the market direction, and then focusing 80% of your attention on EWW. So when it comes time to integrate those, I would put them on the same screen, but with a much smaller screen a screen territory for DIA. You should be able to do that with like a postage stamp as opposed to the big screen on EWW. And that will serve to remind you of the two simultaneous time streams. There's a 3 minute thing where things are popping and I'm getting 10 decisions on
Right.
EWW for every one decision on DIA. It's like you're checking the long distance radar for things that are slowly moving into the valley as opposed to the thing that you're grappling with right there. Yeah, and I would say EWW was just really hard today. DIA was quiet but smooth today. And if you're watching DIA on 30-minute charts today, somewhere around lunchtime, it would have sort of emerged as a pretty orderly trade, and then allowed an afternoon trade that was significant and directional.
Would you have the 30-minute chart and just trade the 3 minute on EWW and actually trade the 30-minute on DIA,
Well,
or
I think you can.
DIA roll
I
down?
wouldn't do that. I wouldn't do that for 2 weeks. I would have it on there for 2 weeks and just get in the habit of looking at it. And I
Okay.
would put, I'd put a yellow dot on a place where you felt an urge. They feel like, hey, that picture made me want to do something. So just put a yellow dot on it. And then just as so you can go back and see what the triggers were. I don't want that. I don't want that to sort of overrule what you're doing with EWW, but we want to be able to start adding a little bit of attention. It's like checking the rearview mirror. You just want to, yeah, okay, just see what's going on, see what's going on. Whereas when you're in the lane, you're accelerating and braking because of the guys that are directly in front or behind you, trying to maintain position. And periodically you're checking those side mirrors just to see what's going on over there. Not
Okay.
making a decision to change lanes, but just knowing which way I could go if I had to. So you don't have to, you spend 80% of your time driving the car in the lane you're in, 20% of the time checking to the left and right. So we just want to start bringing that into our awareness, but without having to make active decisions on it yet. We
Just get used to bouncing the eyes a
Yeah,
little bit,
yeah.
just slower moving chart.
Yeah.
Okay, that sounds like a good idea. And with the log, the log that I'm using, George is actually really nice. He's got this set up nicely. Mine's got some similarities. I'm using the one that Griff presented to us with the course. I made some little modifications in it, but yeah, were you saying just, I mean, I'm tracking everything I'm doing in there, just comparing DIA. Well, I guess if I'm not really trading it.
Yeah, I would just do that visually. I would just do that visually at,
Okay.
because if you started putting that into the log sheet, you'd end up spending more time documenting the log than you were actually attending to the chart. So
Right.
just put a
Right.
dot on there just to say, hey, that's where it triggered me. What was it that I saw, and what did it do in the next 3 to 4 hours? Was there
Okay.
something in there, and is it a pattern I recognize? And after a couple weeks of that, you'll get a sense of when that gets boring, then you'll be say, yeah, let me try the trade on that thing.
Okay. Okay.
That's
Okay,
that's where I'd go with it. So, yeah. So adding the weekly documentation to the stats, I think you're ready for that now that you've settled into standard practice on EWW, and then slowly integrating DIA into the visual display.
Okay.
And
Okay.
and then trust your gut. If that's too much, then just back off on it. But it's one of those things you gotta normalize it on there. It'll be a little uncomfortable, a little different now. Um, what I'd rather do is have you able to spend your discretionary attention on that instead of trying to overthink the 3 minute. There will come a time when even the 3 minute bars will just seem like, well, shit, this is easy. And then you start trying to, you're getting a little fidgety and you want to do things. So you start monkeying around with your rules on the 3 minute, but that's your production line.
Right.
Like you don't want to be monkeying around with the production line. So every time you feel that urge to tweak and tinker and experiment with EWW, you say, okay, leave it alone. Stops in the right place. Let me go monkey around with DIA a little bit. And then you'll get pulled back to EWW pretty quick because 3 minutes will have gone by and you're ready. And then that will actually act as a circuit breaker for you so that you don't get too close to your own screen, if I can say it that way. You start getting tunnel vision and start trying to make things happen too fast and too much. And
Okay.
that can so we got to learn to suppress that urge. When you first start this stuff, you're wondering what to do. There's so much going on. What should I do? And then you get your rules set, and then when they get comfortable, you start wanting to go beyond the rules and start tweaking even more on impulse. We want to channel those impulses into looking at DIA. That's where we want the tinkering and the creativity and the monkey business to occur. With 20% of our attention. When you do that, then you can come back refreshed to EWW and just, do the right thing. So DIA is your treat to your inner monkey to let him dabble. I would say it that way.
That sounds good. I like that. I like putting DIA on the 30-minute. I didn't think to put it on a slower time frame. That's a great idea. And then just easy to it. I like that.
And what that means is, you may only be looking at it once every 10 minutes or 15 minutes. But the 30-minute bar doesn't move that much that you really missed anything by by leapfrogging the time frame. Whereas if you let 15 minutes go by on a 3-minute chart, a lot of things can happen in 4 bars, So that's what I would say about that. Okay.
Okay. Thank you.
Okay. George, let's roll over to you.
Yeah, so pretty much doing the same thing. I wasn't having much luck on 30-minute, so I thought I'd switch to 3-minute for a while.
And 15-second, if we're being honest. What was that? What was the 15-second and 1 minute shenanigans?
So that's actually really interesting. So one of the things I've noticed is that I'm starting to have these ideas, and they're sort of like operating hypotheses, but I can immediately test them.
Yeah.
And my bright idea was that the size of the bar should be in proportion to the speed of the market.
Yeah.
And when the market opens, everything's crazy. And so I thought, well, maybe it'll be more normal on the 15-second bar. So I said, well, I looked on different time frames.
Yeah.
And I said, well, on a 15-second bar, it looks more normal.
Yeah. It's easier to see the guys that are trading faster, they get in, get their thing, and then they go. And that leaves the other side of the trade ready to dominate. So you get the same waves, you get those same patterns, and the adaptive framework is fractal. So you still get to see the PSAR where the PSAR is, the regression lines are the regression lines. So all the sense making is the same. And if you blocked out the the time frame in the upper left hand corner, you couldn't really look at that and say, hey, am I looking at monthly charts or daily charts? The one thing that allows you to detect that it's not intraday is when you see, oh, every bar has a gap. Well, that's what happens on the daily, not so much on weekly and monthly. The size of the gaps on a weekly is only from Friday's close to Monday's open. But, the bars are bigger. And so the size of the gap actually appears to not be as important, which is contrary. It's really the daily bar is different. That's what really separates the intraday from multi-day, and once you get into multi-day, gaps and the longer the bar, the less and less important that becomes. And the more important is the size and duration of the trend. So yeah, it was noticeable that, but you also got to be really quick if you're on those quick time frames. You can't be, spending a lot of time in deep thought. Like we're processing at the same rate on a 15-second chart as we are on a 3-minute chart, but you might have gotten 4 or 5 decisions indicated in that same period of time, which, interestingly enough, was a topic in that information advantage thing, because I heard a lot of these guys saying, what we're really going to use AI for is to study all this data and then offer us sensible alternatives that we can then use wisdom and judgment to decide on. And I said, you're actually smoking dope if you think that's true. Because every 10 years, according to Moore's law, the computing power is going to increase by 100, and it's going to cost 1% of the current price. So you're getting essentially 10,000 times increase in computing power every 10 years. And NVIDIA's chips already have made the cost of AI computing zero. It's free. And the AI models in the chips allow like 100 million tokens to establish context. So we're very close to the point where every single tactical prompt that you give to the AI is the context being provided for that is the sum of all written human knowledge. So it's like, dude, this is not even a case where you're going to be able to provide quality control on the context of what the what the AI is being trained on. And so um, uh, it's not going to be the case of a slow increase in the use of AI as we get comfortable. We're going to lose the arms race in AI if that's the case. So trying to figure out what the human in the loop is actually doing when the computing powers is relentlessly getting better. If you look at it just from a storytelling perspective, right now you cannot tell if the children's book was written by AI or by a human. So in terms of the Turing test for storytelling, it's already at about grade 7. You can't distinguish between them. Once you get into higher order literature, it's still possible to detect the difference, but it's closing that gap relentlessly. So my point is, you can build proficiency on your decision cycle on 3 minutes. It might take you maybe 6 months from the time you first start trading 3-minute bars to really have an internal feeling of confidence that you have mastered a battle drill for your decision making to your own satisfaction. And so when you swap down to the 15-second chart and you see the pattern, and you try to spend your 2 minutes thinking about the pattern that you just saw, hey, 15 bars just went by and that could have been 2 or 3 signals while you're still processing the last one. And so there becomes a sort of a natural limit on how quickly we can adapt to the shorter time frames and still take advantage of the muscle memory that we've built up. Like I can go to 1-minute charts and trade for about a half an hour before I start noticing fatigue. And I've tried on tick bars where, it's like 50 ticks, which can go like every 2 seconds. If it's going fast direction, you're getting bang, 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 bang. And I can do 200 tick bars for about 10 minutes before I'm done. At some point you get in, out, you get little thumb clickers and you're trying to, just be a knee-jerk reaction. So I would just say, I think it's healthy and refreshing to be able to quickly change the speed dial, but just really be mindful of your position sizing and the fatigue level. And longer term, what will help you as you're trying to shorten up the time frame of your production time. Like I was trading on hourly charts and I wanted to go to 10-minute charts. So I tried trading on 10-minute charts and it was just way too fast. So I tried trading on 5-minute charts and then got exhausted doing that. And then I went back to a 30-minute chart, and that was excruciatingly slow. And then I went back down to the 5-minute, and then it was a little easier. And then when I slowed down to a 10, by going beyond the one and then come back to the one you want to do, it actually feels slower than what you were just trying. So if there was ever a time like you wanted to go from 3 minutes to 2 minutes as the bar, you would then try, hey, let me try trading on 30-second or 1-minute bars for a while. And then that'll be too fast. You say, all right, let me just slow down and come back to the 2-minute. And the 2-minute will feel just like the 3-minute. You won't even notice, that you actually have an extra minute in there. You shaved a minute off. Now, why is that crucial? Well, if you looked at 15 minutes of elapsed time, right? And you were looking at 3-minute bars, there'd be 5 candles that you'd have to make 5 evaluations. On a 2-minute bar, that's 7.5. So you're getting an extra 40% front running opportunity because you can see the turn and it'll be a couple bars before the 3 or the 5-minute ever cloud up. Which to me is kind of fascinating, that what you get for accelerating your time bar is the ability to get better fidelity on the turning points. The other thing that you'll end up noticing just while I'm here, I guess, is Watch what happens at the opening plus exactly 60 minutes. As soon as the 60-minute, the hourly bar closes, you always get a pop. You say, well, why is that the case? Well, the reason is there's some number of guys. I don't know how you could even tell, but if there was 10 million day traders, and there's more, how many of them? There's some number of them that are trading on 1-minute bars. So the 59th minute, they did their thing, and now 1 minute later, all those guys are going to trigger again at the close of the 60th minute. Everybody that's trading on 2-minute bars executes at 60 minutes, and 3-minute bars, and 5-minute bars, and 6-minute bars, and 10-minute bars, and 15-minute bars, and 20-minute bars, and 30-minute bars, and hourly bars. All of those populations are all looking at the close of the bar at the 60th minute. So there's a ton of money that's getting ready to auto execute. And as soon as you get the closing price, all those rules that they're using fire. The indicators adjust, it moves over 1 bar. All the rules that evaluate on close all trigger. And so suddenly you get this flood of orders that hits at 60 minutes, and boom goes ring goes the bell. Whereas you don't get that kind of a pop at 7 minutes in. The only guys who are executing at 7 minutes in is the 1-minute bar trader. He's the only guy that gets a new piece of actionable information at the close of the 7th minute. So there's some thought experiments in there. It says, if I was trading on the 60 minutes, maybe I want to front run that by 3 minutes and look at it at 3 minutes before the close, just make my decision at 57 minutes. Because now I've got the bulk of the hourly bar to make my decision, but I can be in the position before that closing pop, and then I can be able to react to the pop. So the timing of the various, it's a polyrhythm that when all of these things come around and they all hit on the hour, gets to be really fascinating to me. The
Does
same
that pop
thing.
cause a sustained move?
Yeah. Yeah, because if you think about it, as soon as the 60th minute bar closes, everybody that is using algorithmic trading are going to evaluate the new position based on, the closing price of that bar. They can't act until that bar closes. But on the 60th minute, you have 10 different populations of traders, each on a different time frame, all evaluating their rules, and then that's going to trigger an order to buy or sell possibly. So now suddenly the amount of money that's being triggered by the close at 60 minutes is different than the amount of money that it triggers at the close of the 7th minute bar. Only the 1-minute traders are going to get a signal to act at 7 minutes. But at 60 minutes, everybody that's trading 1, 2, 3, 5, 10, 15, 20, 30 in an hour, all of those guys got new signals to act, or their algorithms did. And so now you get a big pop because all of those things hit at the same time with microseconds of difference. And that little bump then triggers possibly momentum. Hey, if it moved this far and that, there's the move. No, it's just all of these enter at the close of the bar or something like that, all fire.
So if the majority decide that they want to get long, you get that pop.
Yeah.
And that's carrying through with higher, if you're on 3 minutes, but you've got all those people trading on higher time frames.
Yeah.
Trying to get long, then you can get that carry through. You'll see that lower down that may be more sustained on the lower time frames.
Right. Yeah. So
Right.
so imagine you're a 3-minute trader, and at the 57th minute, you're 19 bars into the day, and it says, on my time frame, it broke the PSAR, so I'm supposed to get long. And you look back and all this thing is starting to be an emerging long move. And then suddenly 3 minutes later, pop it goes, because that was the 60th minute. And all of these other guys now got a trigger to go long. And you get that burst. And now suddenly say, oh, wow, what was that? Oh, that was just all the market orders that hit because of the mechanical way that, the timing model works, in the way that bars are drawn and the way rules are fired. Now, there's going to be some variation in there based on the time settings on the guy's clock. How synchronized is it to the market's clock, and what's their speed of processing and propagation and order execution. So you're going to get a 30-second window in which a bunch of shit's all happening at once. So that's why I've on the hourly bars, a lot of times I just like, well, it's only 3 minutes till the hour and there's a clear buy. So let me just get in now and batten down the hatches and try to front run that a little bit. What's this going to look like to the guy who's trading on the hourly chart? In the same way I make decisions in the last half hour of the day, I've been trading on 3-minute or 30-minute, and I say, hey, when this market closes today in half an hour, if it closes right around here, what's that going to look like to an end of the day trader? Is that going to make him wish that he'd been in today and he wants to buy at the open tomorrow? Well, that could be, if enough guys think that way, it could be a bunch of buy at open orders, which is going to cause the market to gap up. It has to, because there's all this accumulated demand just waiting to execute tomorrow morning. Well, everybody that looks at level 2 can see that and they want to start buying so that they can have inventory to sell at the open. So that drives the price up after hours, which leads to an even higher gap up tomorrow morning. And then if no additional buying comes in, except for the buy at open orders, all that fury, it takes 5 or 10 minutes for all those orders to clear. And then all the buying disappears and there's a huge gap. And now everybody that made money is saying, Jesus, I got to preserve this. And they're going to start locking in gains, which triggers downside action. So the time frame that you choose and the way you make sense of the price action, many times it's just, hey, what's the time cycle that my decisions are being made on? Why is bad news for the administration released on a Friday? Because it'll disappear and nobody will even remember come Monday. Well, so some of that tactical timing has a lot to do with the way we, what we decide to focus on, and some of that. The Fed announcements are like that too. So anyway, the learning point on that one really simply is just say, look, when you're trying to accelerate your time frame, go beyond what you're trying to get to and then come back. Go take 2 steps forward and 1 step back in order to make progress, is how I would say that. When I was trying to go from 5-minute bars to 3-minute bars, I had to drop down to 1-minute bars, get used to that speed. And then when I dialed it back to a 3-minute bar, it seemed like forever. And it actually I felt as unhurried on the 3-minute bar as I did on the 5-minute bar. The 1-minute bar was so fast that when I went back to the 3, it felt like the 5. But I actually had many more bars to look at in a comfortable mind frame, and it made the transition to the 3-minute bars really easy. And then when I tested and went back, once I got comfortable on the 3 minutes, and then I went to 5-minute bars, I couldn't believe how slow it was. It was brutal. It's like, God, I'm ready to make a decision here. And what? I got to wait 2 more minutes? Shit. And 2 minutes, that extra 2 minutes is just not enough time to do anything else except moan and whine about how slow 5-minute bars are. You can train yourself to do anything, really, is what I would say. Okay. What else you got, Jonathan? You all right? Or George, we all okay?
Yeah, that's it for me.
Okay. Hey, Sandeep, let's jump into yours real quick.
Okay.
I would say let's start with the vision and end state one first, and then
Okay.
do a quick look at the SWOT. Because I want to start with the end in mind. What does right look like? And then the SWOT will give us insights into what we can do. Okay.
Okay, I think I'm probably sharing the wrong doc. 1 sec. Okay. So the end state for me is a system that gives me 5 hours per day, 25 per week. And just so not confuse position versus execution, I'm imagining the R to be $400. So for me, I think that given that I'm looking at this as active income, that's really the goal. In terms of critical tasks, I am working on the trading proficiency. I feel I have a pretty good handle on the patterns on 3 minutes, and I plan to keep doing the 3 minutes until later on I switch to 30 minutes. So what I need to master is really the chain trading, which I'm really not good at, meaning I just tend to stick with one pattern. If it fails, I go to a different symbol, which is probably not correct. And the 2-hour battle drill, I haven't had many chances to practice that. The piece that I'm really poor at right now is target selection. And later on, I know that I've gone off the reservation in that I find story stocks, and especially tech story stocks, post earnings or something that have sort of a guaranteed move, and I'm able to apply the patterns to those stocks. But I would like to come back to the set of symbols you trade and master those really. In terms of money management, I conceptually understand the 4-bullet method, but I have not applied it in practice. And I want to fund my account. Right now, I'm trading with an account of roughly $100,000. And I'm afraid that I'm going to blow up my account. So I'm not going to fund it fully until I get to some level of proficiency.
Yeah.
On the tactical things, I really struggle with letting losses run sometime. So the good news is part of my 6 months here was to convince myself that the systems in the market can produce sufficient returns that I can see my end state. But I also have a tendency to experiment a lot. And so I let some crazy idea run for a while, and then it exceeds 1 hour, and then I go to 2 hour and 3 hour, and then I pull, throw in the towel, and now I've got a 3 hour loss. So I'm being more mindful. Maybe I can use some help. Do I just put a stop loss at 1 hour and just that's it? Or are there some other methods? I'm a little confused on the position sizing versus execution R. Right now, I use $400 R as the stop, but at the same time, that conflicts with, should I take a $400 R loss, or should the loss just be much less than that? 0.3 would be, on average, a 0.3 would be a $125 loss. Protecting profits is another thing I'm aware of, but I'm trying to work. I often have trades that have profits that go to loss. And so I'm trying to stick to the $100 no lose dinner for 2. Exits, I'd like to understand better. Trailing bar versus PSAR flips only. With trailing bar, I've tried much larger position sizes, and I feel like I have a good handle on the pattern and the move, and I can get 1 hour on a big position size. But then I don't really understand re-entries. I'm not confident of re-entry at that level. I talked about number 5, my conflict for symbols. I'd like, Ken, for you to tell me to stop doing what I'm doing with other symbols, or some method to incorporate those symbols. I feel every time I use a non-sanctioned symbol, I have a conflict. A review of my TC 2000 setup, anything I can do to improve. And then share my trading plan for review. The last are things that I need to know, but I don't really fully understand. As I've talked about target selection for the week and the day ahead, I'm familiar with the theory of sectors, but for some reason I don't understand which target to focus on for the morning trade, the afternoon trade, and the lunchtime trade. And so far, because I focus somewhat on the earning stocks, there's always a movement in those stocks, and so I sort of can ignore the rule. But I realize that as I go towards a portfolio of stocks, I need to be much more disciplined on that. And then I watch what you do. I want to get to a hybrid swing trading on 30 minutes, but I need to get comfortable with the 3-minute pattern. And what you just talked about, the frequency and timing, makes me think that 3 minutes, I should stick with 3 minutes for some more time.
Okay. Yeah, so here's what I'm gonna where I'm gonna be directive in nature for you. So the first thing that I want to say is this is achievable at an end as an end state. But this requires the 5 hour a day on 20 trades a day means that you just about have to be on 3-minute charts with about 5 to 10 symbols that are cooking so that you can get that frequency. If you are picking the targets and you're doing pattern analysis and human decision making. Otherwise, I think the fast path is either index or Forex on 1 to 3 minute with auto trading, human in the loop, where it nominates the pattern and it's going to take it if you say go, or it's going to take it unless you veto it. So there's sort of a the role of the human in the loop to do that. So that's going to lead you to one of 2 pathways to mastery. The first path is mastery of the patterns for a specific set of rules, so that if it involves entry and then re-entry, or entry, stop, and reverse, in other words, the SSC, and the right way to do that is you say, look, I'm either going to trade the SSC directly because it took a harsh winter to trigger the SSC, and if I take it long and I get a successful trade, then my re-entry is the COTA 2 for as long as I keep getting higher lows and higher highs. So that's the chain trading we want. Or the SSC is going to fail, and now I'm going to be in a collapsing dragon, and then that's a beauty because the previous harsh winter has established that the primary trend is down, and this was an effort to reverse it, which physically failed. So now I have 2 pieces of data that tells me that this collapsing dragon is going to work. The first piece of data was the fact that we had an abnormally large, harsh winter, which establishes a downward move. And then the second piece of data is that we had a temporary pause and the first effort to reverse it, and it immediately failed into a collapsing dragon. So that reinforces the fact that the buyers are weak, and that strengthens the sellers who are already strong. So that's why the collapsing dragon is the preferred entry intraday, because more traders are optimistic. The naive traders who are emotional and over leveraged are optimistic, and when it fails, they panic, and then you can pile on. So the pathway to mastery of the patterns means you got to be a master of the SSC, the COTA 2, and the collapsing dragon, with the harsh winter as the filter, which says, I'm ready to get in. So that's step one on that pathway. I need harsh winter first, then SSC, Kata 2, and collapsing dragon. The second pathway says, instead of waiting to see a harsh winter, what I'm going to do is I'm going to see the market closed here on it yesterday, and then there was a big gap in either direction. And the fact that there was a large gap substitutes for the requirement of seeing a harsh winter. What the harsh winter says is this symbol just made an abnormally large directional move and is in play. And therefore, when it's in play, you can bet that all subsequent moves are going to be larger than normal until we figure out who's going to win, and then all the emotion subsides. So what we're looking for are symbols from our stack that are in play. The harsh winter is the indicator that tells us that thing is in play more than the other symbols and more than it usually is. That's why it's going to have an abnormally large move. The second stage of this, instead of waiting for the harsh winter, because we'd actually like to participate in what turned out to be a harsh winter. Like, I wish we could have gotten in on this thing and then enjoyed the move down. So how can I do that? Well, especially that harsh winter is normally like 1.5 frog boxes, which is like 5 R10s. So that's a significant move, especially if we're risking 1 R10. That means when we officially get a harsh winter, it probably had 3 to 4 directional moves right away, quick, fast, and in a hurry. Well, how can I do that? Well, if I've noticed that this was the close and now the open happens with a big gap, we know that a big gap in either direction is a signal for a larger than normal move in either direction, and we can't predict. But we can predict that the size of the move, once it goes, is going to be larger than normal. So in stage 2 of this, I replace the harsh winter as the signal that we have something in play. I just accept large gaps equals in play. And now, no matter where it opens, as soon as it opens, I have simultaneously the high and the low of the day. And the bigger the gap, the more likely it is to be a range stat move. So if I can bracket the open with an R10 on either side, I can get the breakout right away, quickly get to no lose plus dinner for 2. Then if it turns out that thing it made a harsh winter move, I'm starting the day with a 3R win. And then I'm moving into an SSC where I'm either going to get a retracement or a further collapse. And now I'm on the right side. I'm on the side of the angels. So the next one is using the gap. Now, in order to play that, what I really have to have is probably 3 or 4 symbols that I'm comfortable with and that I framed, and I can pick the one that had the biggest absolute value of the gap, and then focus my attention on that for the first 30 minutes and just say, since that's the most likely mover, I'm just going to do that for 30 minutes. And then when that's done, I will shift back. I'll take a deep breath, let it out. And then I'll start evaluating all 4 of them to find the ones that are starting to make the morning moves after the opening smoke has cleared. What you're ready to go from waiting for the harsh winter and then trading it, you're ready to start doing the gap. Once you've mastered that on your preferred symbol, you're just practicing the R10 breakout in either direction. That is a form of hybrid frog, where we're taking a very, very small risk box, like 1/3 of a frog box, and then bracketing it and get going. Once you get proficient with that, with live money, then you can build out to where you have 4 symbols to choose from and then pick the biggest gap and let's go. That takes a little more conscious attention. So that's one pathway to mastery if you're going to use the human intervention and target selection. The other pathway I'm going to tell you is I'm going to trade off that first 30 minutes of enthusiastic moving, and I'm going to look at indexes like the DAX or Forex pairs, and I'm going to trade them probably on 3-minute or 5-minute bars, and I'm going to trade them all day, and I'm just going to take advantage of the fact that it has orderly waves rather than big spiky moves. And I'm just going to trade orderly ocean swells all day and take my piece out of the middle with relentless discipline and robotic attention to detail. To do that, what you want to do is what Luke is doing. He's put his little rules together and he's getting 10 to 15 trades a day on indexes and Forex pairs, and he's not optimizing it, but he's getting the 10 to 15 trades a day with a reliability rate that's really good. Right now, he's got about a 40% win rate, 60% loss rate, but the win rate is paying 2.5 to 0.8 of the loss. So basically, he's winning 2 out of 5, but he's paying off 3 to 1, and he's getting 10 or 15 trades a day, which means that his success rate when he goes net on a daily basis, that turns out to about 70% winning days, 30% losing days, and the winning days are twice as big as the losing days. So the aggregate on that is really attractive and it's robust. If you expand that out to what is the weekly performance, if I go net for the week, you really want to trade that thing and simply review the weekly performance. Now, what I would say is, which path should you take? I say yes. You should be able, just by concentrating on EWW on 3-minute bars, you can compare your performance and collaborate with Jonathan and Jeffrey and the guys in the chat room who are trading 3-minute bars. Kevin Redekop is doing that on 3-minute bars with EWW. So you got 3 or 4 guys every day who are just doing EWW on 3 minutes. Now, what we got Jonathan ready to do is how to start expanding that into a second symbol. Once you master that, you'll be in the position to say, how do I make that 3 symbols and then 4 symbols? And then we can pick the appropriate set of 4 symbols so that you always have one of them that is more likely to be moving. And that's where you slowly start building up towards my stack of hybrid trades. Now, if you go from a 3-minute, you can build up over 6 months, I think, to about 4 symbols. When you expand out to 30 minutes, you can get that up to 15 or 20 and still be able to manage that on the 30-minute bar and then drill down to the 10 or the 3 to fine tune your entries with size. I think the last thing that I'm going to say is that in order to get to the $400 of R, I'm going to say start off with $10. Don't worry about the cost. Don't worry about the cost and the slippage. That's irrelevant. When you're trading with $400 of risk per trade, the admin cost of commissions is irrelevant. If you're trying to make money on but you're only risking $10, it's significant because it's going to represent 20 to 30% of your potential gains are chewed up in the commission. And you say, well, I can't make any money on this. No, when you go from 10 to 400, the cost of the commission doesn't scale, but your gains will, and it'll cover the cost easily. So don't worry about the cost, but start trading with $10 of live risk so that you have skin in the game so you can experience what that's going to do on your psychology. Then as you do parallel development, I'm going to say the mechanical index approach from Luke, or the human in the loop with EWW going towards patterns and snipers. If you had the 100% of your portfolio, you're going to then end up making a decision about how to allocate money to this side for the human and this side for the mechanical, and then you'll get the blended return. And that's going to be a good way to develop in parallel and then make a final decision on how you want to allocate the assets. But you want to be able to do both, because there could be a time when, hey, I want to take 2 weeks off or 3 weeks off. I don't want to be at zero. I'd like to have a system that could continue to work without my direct supervision every day. So that's why I would say, in order to master the patterns, go to $10 risk per trade, get on board with the EWW 3-minute and 30-minute patterns. When you're ready, you can expand out to add DIA like Jonathan is doing, or you could experiment with the 10-minute like Kevin is doing. What he finds is that he sees a pattern on the 30, and then he dials down to the 10-minute to improve the entry. And then when he's trading with the 3-minute and the thing makes a reverse and he's doing good with the SSC, and this thing is comfortably in the money, he can go from 3 minutes to 10 minutes so that his decision making is not as hurried, and that creates time and space to look at another symbol. So it turns out that if you use 3 and 30 as your primary time frames, they are different enough that you get 2 different focuses, but you can use the common 10-minute as a way to optimize both of those time frames, and that's what Kevin is exploring. So that's what I'd like you to, I think the most important thing you can do is get on board with the EWW. Don't worry about trying to do target selection and all that other stuff. Start with a well-known standardized target, compare your charts with Jonathan and Kevin, and compare notes and take a look at the, I'm trying to post an EWW chart every night on 3 minutes. So as an additional data point for reference. And then I would plan on doing that for 2 to 3 months as you get till you get absolutely bored with it. You know, you'll get used to looking at the 3-minute and the 30-minute. Like if you spent all day trading the 3-minute chart, occasionally step out and look at the 30-minute. If you started with the 30-minute, when it looks interesting and you made an entry, then dial down to the 3-minute and see what the 3-minute chart was doing when the 30-minute chart triggered you, and you realize that the 3-minute bar probably had a turn like this, and on the 3-minute you got a COTA 2 entry after a successful SSC, but on the 30-minute that looks like an SSC on 30-minute because it had to reverse that much to trigger the SSC on the 30 minutes. But on the 3-minute, you'd see that as a COTA 2, and you'd feel a lot better about the entry that you just made. And that's one of the ways that you can decide if the 3-minute or the 30-minute is more to your liking. So I want to hold off on the SWOT right now because we got like 22 minutes before the nightly podcast goes. And I want to get to the, I want to address Juan Carlos's. So let me jump here and shift. First, any questions on any of that? Make sense?
No, that was great, Ken. So thank you.
Okay. All right. So Juan Carlos, let me see. Here's what I want to cover with you. Yeah. So this comes down to let's see. What's the deal with the collapsing dragon? Okay. And you identified 4 cases. Here's what I want to say. Here's what I want to say to you. And I'm going to put it in the frame of reference. There's 2 cases where we get collapsing dragons. Okay. Collapsing dragon happens on 2 different cases. In one of them, this is like the SSC side. You had a harsh winter and the R10 reversed a sufficient distance that that the PSAR, which is built off of the RL10, was triggered. Somewhere in here, either the R10 or price triggered the PSAR, and you get an entry, and then up you go. Now, if that works, it works. When the RL10 crosses the PSAR, when that bar closes, like price could have already been up here on when the RL10 is crossed by when the PSAR is crossed by the RL10. When that bar closes, price could have been up here, and then the PSAR will flip, and it will be at the same exact price as the sharp point on the RL10. It has to, because of PSAR being used to compute the PSAR, or the RL10 being used to compute the PSAR value. Like the PSAR will only flip when the RL10 officially hits it. It hits it when the bar closes. Now, price could have closed up here, but when the math is computed, the RL10 is drawn here, it hits the PSAR, and then as the new bar opens and starts moving, that I should have drawn this is where the PSAR flips. This is the trigger for the collapsing dragon, right there. The collapsing dragon occurs when price violates that line, not when the RL10 crosses it, when price crosses it. Now, why is that? Because this collapse is going so fast that the RL10 is actually 2 to 3 bars slower, and price will have moved 2 or 3 bars below the collapsing dragon signal by the time the RL10 crosses this lowest dot and officially triggers the collapsing dragon. Now, the collapsing dragon occurs when price violates the beginning PSAR dot in the new level. Because if this thing worked, that PSAR dots are going to look like this, a nice big long trend. The collapsing dragon is not triggered by any of these dots being closed. The collapsing dragon occurs when the RL10 and the first PSAR dot in that new stack gets violated. That is the collapsing dragon. So we're not going to wait for the RL10 to cross through there. As soon as price violates, we're short. Check or hold. Now, here's why that works. Price was moving down in the harsh winter. Typically, that last bar was an exaggerated bar, and then it closed here, and then it started going up and up and up and up and whatever. The RL10, because it smooths out those closes, would look something like this. So if I looked at the absolute price point, here's where the RL10 found support and reversed. This is where the actual lowest price in that sell-off occurred. This is where all of the guys who are going long are placing their stops. So when the RL10 or when price reverses through this right here and we trigger a collapsing dragon, there's still actually a little bit of room before all of these little stop orders are hit. When price goes below this line, this explodes because all of those exits hit, and then price collapses in a great big red candle. So when price collapses below the point of the RL10, the CD is triggered, and then usually it will come down and test this low, and it hits those stops, and then the thing collapses. But we're already in the trade, and when that pop happens, we're likely to be able to get to no lose. So we can't wait. We cannot wait for the RL10 to come down here and trigger, because that's 2 or 3 bars behind price, especially if this collapse happens fast. Check or hold.
Here.
All right, so the first case is an SSC, and we have a harsh winter. It reverses briefly. Now, it may or may not even trigger the SSC. What I would love to see is, hey, here's the R10 risk box off the low. And this is probably where the PSAR is triggered to the upside, and that's where I'm going to get my entry to go long. What I would love to see is the R10 comes down to here and then can't even get out of that box, and price collapses back through here.
Yeah.
I'm so short on that, you can't believe it. When price cracks below here, all we know is that this previous harsh winter is going to go, and we're going to get another one of those big moves. So the CD occurs when price violates the pointy edge of the R10, which is also where the first PSAR dot is going to draw when the PSAR officially flips. If the SSC works, then we would see a long, glorious PSAR rising. So that's the first case, is when after a harsh winter, the collapsing dragon is actually leg 2. Now, here's where the other time that you get this is on a failed bull. So I had a really strong move, and the R10 peaked, and it came down here, and I was trying to get my little Kata 2. And so here was the dragon. And so what I'm hoping for is I had something like, I had a nice entry on the long side here. It rolled over. And when the R10 peaks, I like to exit at the skin of the dragon. Check or hold?
Yep. Perfect.
But what I'm hoping to see, here was my lowest low before. And then what I'm hoping to see is the R10 finds support, reverses, crosses through the dragon, and then resumes. The Kata 2 occurs inside here after I'm on the north side of the dragon again, but before it breaks out above here. This is an emerging dragon, and I've waited for the extra confirmation. But I want is the Kata 2. And then hopefully this thing just goes on forever. That would be nice. Just a minute.
Can I have a question? Is the
Yep.
violation of the low sufficient to trigger a collapsing dragon, or do you need to wait for the close?
I go with, I just, as soon as it goes through, I just say the heck with it. Because if I go as soon as price crosses and it fails, I'm going to show you why that's a collapsing. So this is what happens if your successful SSC happens. I had a positive move. I had a short retracement and then a resumption of the powerful move. And the kata 2 is successful. So kata 2 successful. Hooray. But where you get the collapsing dragon in this scenario is, well, if I went down to the last time this thing reversed, way down here, there's a collapsing dragon. So no matter what happens, anytime, if price after, no matter where it goes, anytime after this, if price came down and violated the original support level, I've got a collapsing dragon. But
Oh,
what I want is the more typical place is I had a successful trade. I had the little pullback. I was trying the K2. And now instead of, let me show you, this is where success occurs. Success on that upside move occurs if it gets above the previous high of the R10. Check or hold?
yes.
Yeah. So the kata 2 actually is getting in between the edge of the dragon and the top of the R10. Check or hold.
Yep.
And my stop is going to be right here. Because this acted as support on this leg up, but if it fails below here, I now have a collapsing dragon. Now, what I want to see is I want to see this thing fail before it gets above that, because now my pattern looks like up, down, lower, high, and now there's my collapsing dragon on this. That lower high, this is actually the supported fall crossing, also known as kata 2 to the downside, because that's symmetrical. The kata 2 to the upside was this. I had this and this. I had a low, I had a higher low. That was a confirmed positive move when that high was breached, and I'm good to go. That's a successful kata 2. But if it can't get through this price level, then my first collapsing dragon is going to be this one.
Yeah.
That's this one. And now if I get a collapsing dragon here, it's going to come down to this support level. This is the all-important crucial test. Why? Because the last time it was here in this scenario, it held support and I got this beautiful move. So my expectation is that it's going to come down and find support where it found support, and it's going to rebound and go until proven otherwise. So if I can get a collapsing dragon here, I want to make sure that I make money in here. But if it fails through here, then the original collapsing dragon is still in play, and now I can get my second position. Now, here's what I want to say. So take a look at here's where the R10 bottomed out. This is where the PSAR flips and is starting to move up. Here's where it came down. When price fails, the collapsing dragon occurs at the violation of the first dot, the lowest low on that sequence. So when the SSC, here's the collapsing dragon. It's not if this thing was successful and then comes down to here and hits the PSAR. That's just an exit. That's not a collapsing dragon short. It's not a collapsing dragon short until the first support level that held collapsed. All right. So to review. On a case number 1 is harsh winter, tried to rebound, fails fast.
Mhm.
This little line is the collapsing dragon. That is the preferred one because I have the harsh winter and I have a failed reversal. That makes this a very strong signal to the downside. The second case is successful trade up, failed kata 2.
Yeah.
Because what I have now is I have this, and then if I look at the RL30, the RL, which is black in color, not red, just a minute. The RL30 will have rolled over by this time, and this is the owl.
Mm.
And now my short is here, and I'm playing back to the original support level. That's why this is a test. But my risk box is simply this, right? And if this was a really good move, then I could probably see 2 or 3 to 1 just to come down and test this. So if I can get short here, I want to. But when it gets down to here, I am pessimistic about the short. I've already made my money, and I expect that it's going to find support here on the test. It's going to find support there, just like it found support here. And the last time it was there, it did this. So I'm fully prepared for it to do that. But if that collapses, then all of the positive emotional energy of this, of that entire move up, it's all gone. Because this is now it's the beginning of the harsh winter.
Yeah.
That will look like, when this collapses, this whole move is going to look like a harsh winter. And that's going to lead to another SSC down there somewhere. So, in conclusion, what you want is, on the breakout of the SSC, you want price crossing the PSAR -1. Price starts moving up. When price breaks out, that's where you want to go long. It'll take 1 or 2 more bars for the RL10 to get through there, but you want to catch that as it breaks. Similarly, on the downside, when the harsh winter occurs, the original dot of the PSAR, when it flipped, that's where the original collapsing dragon occurs. That's where you must be short. If I had a successful trade up in here, and it starts to roll over, I want to try to make my exit so that if that was my risk box, maybe the exit here gives back 1, but allows me to preserve the 2 units of gain on the upside. So I don't want to let this thing come all the way back here and then scratch and then get short. Then I wasted that nice big upward move. So I actually have to do something like, when the R10 peaks, I have to be able to cut that to give back 1 in order to preserve 2.
Mhm.
And then collapsing dragon is here at the base, the new base of the PSAR. Clear?
Totally. Yes.
Okay. That's everything I want to cover on this one. Everything I want for tonight. The other one starts in a couple minutes, and I got to prepare for that in a hurry.
Mhm.
So we'll get this processed and posted in the usual spot on Rizuku in the course, and chew on that for a while. And then, Sandeep, if there's any questions that come out, you don't got to wait till next week to send me as you start, catching up. Just send me your questions. Don't stay stuck too long. It's okay to be stuck a little bit, but don't stay stuck too long. Okay,
Yep, thank you.
all clear, guys?
Thank
Off-
you.
Okay,
All right.
off we go.
Bye.
See you soon. Oh yeah, Sundeep, while you're still, okay, I'll catch him later. Never mind. I think I answered this question from chat. It's when price breaches, we trigger. We don't wait for the bar to close and then trigger. As soon as it violates, just act. Be
Yeah.
done with it.
My confusion was trying to create shorts without the extra hump.
Yeah.
So break the pre-SAR, I was like, I'm losing all this space.
Yeah.
So why not get short? And I was getting rebound and losses, and it was not clear.
Yeah,
So,
the main thing you want to do is you're looking for this action here.
yeah,
And if it was this, you get your second entry down here. So you can be short here with the second position here. That's the big one.
yeah. Perfect.
And
And
then
I'm
the other pattern is, that's if this was successful. But the other pattern you really want is harsh sell, trivial rebound, and then instant.
Yeah.
That's that's the one you want.
Super
Because
profitable.
there were no buyers. There were no buyers to come in to turn this thing around.
Yeah.
So that means this was just a pause and collapse.
Mm.
Right? And this leg is going to look like that leg, huge, harsh winter. You want the shortest amount of time in the pause and then a continuation. But if you have this and it pulls back, you're not thinking short. You want to cut it so that you can get a re-entry. And then if it goes above here, that's where you really feel good. But if you get this, that's the CD.
Yeah.
You got to have this lower highs, and you're about ready to make a lower low. That's all you need.
That RL10 twist, that's my re-entry, and it's super profitable. When it happens,
And this is your, and then if it holds here and goes back up, that's your entry long.
Yeah, that's the emerging dragon.
Yeah, the turning points on the R10 establish critical channels. Anyway, enough of that. Okay.
Thank you.
Yes,
Thank
sir.
you.
Yep.
All right, bye.